staying focused on what we're doing. And I believe in that, but also don't lose sight of your peripheral vision. Make sure you're watching what's going on around you and who's doing other things. Make sure that you're taking accountability of partners. Make sure you're reading reports, that you're getting the KPIs, the key performance indicators on balance sheets and profit and loss statements that are really giving you the detail that you need to have. Um, Make sure that you are, not over leveraging. Make sure you got capital. I think those are the key components that people need to be careful of.
As an operator, I know other investors are romanticizing multifamily investing, and I'm looking to learn from other investors' mistakes. I know you are too, and you found the right place. Welcome to Myers Methods Presents Multifamily Missteps. Hey everybody, and welcome to Myers Methods Presents Multifamily Missteps. I'm your host, Jerome, and I've got Mike Morawski with me today. Did I get it right?
You did. You got it perfect.
Man, I always get the pucker factor going when I get different names from different countries of origin. I always want to put a little bit of respect on folks' names. So Mike, so grateful for you joining us today. We do things a little unconventionally here. Before we dive into your story, if the listeners want to get in contact with you, what's the best way to do that?
Oh, perfect. Yeah, you can go directly to my website and catch me. That's mycoreintentions.com. And you can reach me by email, and I am very open to networking with anybody. It's Mike at mycoreintentions.com. But Jerome, as value, I'd like to offer to your listeners a book I wrote last year called Exit Plan. And it is your complete guide to multifamily investing and why you need an exit plan before you buy. And they can get a free download of that book at mycoreintentions.com/exit plan.
Wow. Free book. I'm not giving my book away, so you guys better go grab Mike's. There's a whole lot of work that goes in the book, so it's a very generous offer, my friend. So, Mike, you've got a really interesting story. And shout out to Frederick Bussey for putting us together, because I don't know that I would have got you on the show without him. So let's dive in, man. What's your background? Let's talk a little bit about where you've been and what you've been up to.
Yeah, so let me say this real quick though, because you just made a really interesting comment, right? And that is that books take a lot of work. I have a newfound respect for authors today. I never in my life had any idea how much work, time, and money it takes to get a book done and get it out. So people need to, so many people say, I said for years, hey, I want to go write a book, but, I never did until I had time. And I'll tell you how I got the time to do it. So, hey, I've been in the real estate space like 30 years. I started out as a real estate sales agent, and it's kind of funny how I got there, but I've always believed in the saying that success leaves clues. And I think that Jim Rohn said years ago, success leaves clues. And if you follow successful people, it greatens your chance of being successful. Whether those successes or failures that you follow somebody on, you're going to get some great clues. So I was in the construction business, had a really great residential remodeling company in the northwest suburbs of Chicago. And I woke up one morning and I was just burnt out. I couldn't do it anymore. I was tired, and I sold the company and took a year off. And during that year, my wife at the time and I, we house hacked a couple of houses. And now, Jerome, this is long before house hacking was sexy or it was the thing to do. Nobody was doing it back then, right? So we house hacked a couple houses, and along the way, I met this real estate agent. And at the time, he was really successful. So I went to him and I said, listen, I'm thinking about going into real estate. He said, man, I think you'd be great at it. And I said, great. I said, could I come and shadow you and follow your team around, see how you do things so that I could model you? He said, no. And I was a little taken back. He goes, I'm going to do one better for you. And I'm going to date myself here a little bit, but he says, I'm going to make you a cassette tape. And you can take that cassette tape, listen to it over and over again, and follow the fundamentals. And that's exactly what I did. I listened to that tape over and over again, and I equate it to podcasts like this one today. People can go back, listen to the material again, gain more knowledge and gain more information. But I listened to that cassette tape, and as a result, I went into the real estate business. And in my first 9 months in the business, I sold 78 single family houses.
Whoa.
Remax
That's
Rookie of the
monster.
Year. Yeah. Remax Rookie of the Year that year. I went on to build a team selling 125 homes a year. So we were tearing it up for about 7 or 8 years. In 2005, I saw the market starting to shift and change and knew that I was going to have to go do something else. And I wasn't really sure what I was going to do. I just knew that I was going to have to change. So I'd always wanted to be in the apartment business. I didn't just wake up one morning and say, hey, let's go do this. It sounds like a fun idea. But I had watched some other syndicators in my market grow and do really well. And so I understood that model that you raise private equity from individuals, you marry it with a great real estate deal, you stay in the middle, and as long as everything goes well, everybody makes money. And so I thought, let me try this. I syndicated my first deal in 2005, did rather well. And over the next 30 months, I raised $18 million, bought $60 million worth of real estate, and it was 4,000 apartments in 5 different states, and built a property management company managing 7,500 units. Fast forward a little bit, 2008 rolls around, and it was like hitting a brick wall in a freight train at 200 miles an hour. We derailed. And here's what happened along the way. I grew that business in a very short period of time, so I was very unstable. I'll give you an example. In 2017, I closed 17 transactions for 2,700 units. And I didn't hardly have time to catch my breath or balance the books, right? So we had started to come off the rails because we were very unstable. I was over leveraged. I was 85% loan to value on most of my deals, where I should have been 65 to 70% loan to value. I was undercapitalized. I didn't raise enough money. I took a provision out of my private placement memorandum that said I could go back to my investors and raise more capital if I needed, because the market was so hot and just growing so fast that I thought I'd never need to go back and ask for more capital. We're going to be fine. Well, little did I know 2008 was going to happen. So all these things combined, and then I didn't pay attention to detail. So I didn't watch what was going on around me. I had people come to me, like my wife came to me and said, hey, I don't trust your partner. A week later, my attorney came to me and said, I don't like what's going on. You better pay attention. I said, don't worry, I got this handled, right? Well, I didn't have it handled, and we imploded. I came off the rails, and I thought, well, let me try and save all my investors. The fact was, hey, I never flew private. I didn't upgrade cars. I didn't buy a boat. I didn't buy a bigger house. I tried to save my company and build this company. I had 38 different companies, some that were very profitable, some that weren't as profitable. And so what I started to do was take money from the profitable companies, move them into the non-profitable companies. Now, here's the other factor that goes into this. I'd been around long enough. I'd seen a couple of recessions in my time. They normally last 17 or 18 months. The correction is 10 or 12%. 2008, that thing lasted 7 or 8 years, a 40% correction in the marketplace. There's people still that are affected by it today. So there was no way to really mitigate out of that. I should have just let some deals go to foreclosure and a number of my investors get hurt, but I didn't want anybody to get hurt. And I'm the kind of person, Jerome, I don't want to have to come to you with bad news. So because things started to derail and I tried to fix them, my attorney and accountant said, hey, you can go ahead and move that money. Just leave a paper trail, which I did. Here's where I made a mistake. I did not tell my investors what I was doing. So for non-disclosure, I wound up being charged on federal wire fraud and mail fraud charges and sentenced to 10 years in federal prison. So I went from living this decent, modest, middle class lifestyle. I was the neighborhood baseball coach, the soccer coach. I was home most nights for dinner. I had a great marriage, to all of a sudden being ripped from that, put in a 12 by 12 room with three men I didn't know, nor did I like most of the time, living out of a 2 by 5 locker with three green outfits and 5 pairs of underpants, wondering what the hell happened in my life. So now I'm in a position where it's like, what do I do? Every day I'm walking around thinking my life is over and it's wrecked. And I was in prison about 17 days, and then my wife decided she was going to divorce me. And when she decided to divorce me, then I went, my life really is over. So, prison's a funny place. People wind up coming around your side and helping you and supporting you, and it's an interesting environment. And I met some really great guys, and have some really great friendships as a result of it today. But I had a guy walk up to me. I was probably in about 6 weeks, and he walked up to me and said, "Hey, don't let these people beat you. All they want to do is take everything from you." And they can take your real estate, they can take your cars, they can take your business, they can destroy your family, but what they can't take is what you're made of, what helped you build those businesses, what helped you create the companies that you created and do what you did. He goes, you can go get that back. But he goes, right now you have to work on yourself. And it was the best advice anybody ever gave me. I was like 35 pounds overweight at the time. He said, come to the gym every day, start working out. And I did. I started to get better physically, feel better. I decided to go to college. I went to college. I got a bachelor's degree in theology. I wrote 2 books while I was gone. Exit Plan was one of them, another one on property management. I wrote a home study courses. I wrote an ethics course. I taught real estate and ethics in prison for 5-6 years. I was on an outreach program. Went into the community. I told my story like 40 different times to small business owners and local area college students. And then I wrote a paper with a professor from the University of Minnesota that we had published this year in the Business Journal of Ethics. It was an ethics case study that they use at the collegiate level now for forensic accounting classes and sales and marketing classes. And today I'm in the coaching and training space, and I help people build a business, scale their multifamily real estate investing business, and hopefully help them to live a balanced lifestyle and not make the same mistakes I made. So
That's a wild ride. So, I mean, I think everybody listening is asking this question. Like, what happened to your partner? Because it sounds like he was the one that was playing games, but you were one that was impacted in a real way.
yeah. So my partner, I was actually on vacation in 2010. My partner, during the time I was on vacation, went to the grand jury. He and my in-house legal counsel and director of finance carved a deal with the prosecution, with the government, and testified at the grand jury to throw me under the bus. He served 30 months, and I served about 8 years on a 10-year sentence. So, and the other two didn't get charged. So they crafted a deal, for that to happen. So
Wow.
yeah,
So,
what? Listen, I don't blame anybody because I broke the law, right? I broke the law. I didn't disclose to my investors, and I should have told my investors, and I should have done things a different way. But I tried to save everything, and like I said, I didn't pay attention to some of the other details going on. So
so this is one of my biggest fears and one of the reasons why I don't raise money and do syndications because so much can go wrong. When you say you didn't disclose to your investors, is that commingling of funds, or what was the actual infraction that was worthy of federal wire fraud charges?
So here's the deal, right? When they say wire fraud or mail fraud, those are vast charges, right? You could go to prison for mailing your electric bill in or wiring your cable bill payment online. That's how vast those charges are. If the feds want to put you in prison, they're going to put you in prison, and they'll just say, "Oh, because you mailed your bill like that." I really what that mail fraud and wire fraud stuff was on was because we took investor funds wired into our bank. That's what that was all about. Um, and really what they said was that it was non-disclosure. Like if you read my court transcripts, it's because I didn't tell my investors that I was moving that money back and forth between companies, and we were just trying to save the company. um, Matter of fact, if you'd have been in court that day, or at sentencing, there were like 22 investors that were in court that day that were there like victims. They were representing the government, and 20 of the 22 said, "Don't put him in prison. He's worth more to us out trying to make money and pay us back than he is going to prison." So, it's kind of interesting. I think a lot of people were shocked that I actually went to prison for as much time as I did.
Well, yeah, I mean, that sounds like they're making an example. But the part that I guess I want the listeners to grab is, when you buy big deals and you scale quickly, having the capital reserves when things don't work is of essential importance. And Mike could have went back and did capital calls for each individual project and maybe gotten the money in that way, but he was trying to fix it. And in trying to do something good, he ended up in a very precarious space. And 8 years of his life were spent where he didn't have any of the luxuries that most of us enjoy that live in the United States. Is that fair?
Yeah, absolutely fair. Yeah.
And so, you're out, you're trying to help people learn from the mistakes that you made along the way. The consequences are huge. I mean, not many people could do 17 transactions in a year via syndication way back in 2005 2010 timeframe. I mean, I don't even think most people knew what a syndication was at that point.
Right.
Yeah. And
Yeah.
so it shows how talented you are as a business operator to be able to find deals and capital, put them together, get the transactions done. What market were you buying in?
That's funny, right? I live in Chicago, but I bought one deal here. My biggest footprint was in the Dallas market, which today is still in the top 5 markets to buy in. Dallas, Alabama, northern Alabama, so Huntsville and Decatur, and then in the Ohio Valley. So if you look between Indianapolis and Cincinnati and Dayton, in that market there, I had a footprint also. So we're in 5 different states, 5 different markets, and today I'm back syndicating deals. I actually have approval from the SEC to go ahead and be an issuer of securities again and do deals. And the board of realtors said I could go back and get my license if I wanted. And I almost think it's a recant, right? Of you really didn't do anything wrong, but I did. So I'm not. I want to. I take full responsibility. So, hey, look, I look at it this way: God had other plans. So, and where I was headed. So.
A lot of people want to be profitable multifamily operators but lack the knowledge, deal flow experience, and capital to be successful. They often try to overcome these challenges out of order, slowing or eliminating their ability to get their next deal done. We've developed a framework that allows them to gain the knowledge they need to find profitable deals. When they do, they create the time and location freedom, as well as the generational wealth they desire for their family. The Myers methods of multifamily investing have proved to be the fastest way to establish credibility and profitably grow an apartment portfolio. If you want to know more about our 4-step process, jump over to myersmethods.com to get our free 4-step guide. to getting into multifamily investing. Let's get back to the episode.
So, as we think through this and, you're back in the game, you're helping other people figure out how to get the thing done. Well, first off, how did you even figure out how to do it? Right? Because there weren't a lot of educational programs back at that time. That was more like 2010 to 2012 when a lot of the guys started talking about this. I mean, at most Dave Lindahl was around, but I don't even think he was running a big business at that point.
Yeah, no, Dave Lindahl was the only guy out there at that time. And this is what, when I was in prison, I thought, oh, I'm going to go back home and I'm going to teach people how to do this. And then all of a sudden I figure out there's, 15 other guys out there training on it. I'm like, oh, that's crazy how that market changed. But I know there's still room in the market, right? So my whole goal is how do I disrupt it a little bit? But here's how I figured it out. So when I was in the construction business, I did a lot of work for Inland Real Estate. Inland is a company that started by 4 high school teachers. They bought their first 4-unit apartment building in Chicago, on the northwest side of Chicago. And they went on, today they're in 80 countries. They're the largest REIT in the world. They own banks. They've grown to be an incredible company, right? They have 7 or 8 different public REITs. A REIT is a real estate investment trust, that people, it's like a mutual fund type situation. Your money's a little bit more liquid in a REIT than it is in a private REIT or in a real estate transaction. So,
wow. So you watched them do it and you just kind of modeled after them.
right.
And so, there's somebody sitting out there who's done a transaction or two and they're like, I'm ready to go to scale. 1,700 doors or 3,000 doors sounds amazing. What do you say to that person?
Go slow. You can do it, and you can do anything that you put your mind to. But just go slow. Make sure that your documents are in order. Make sure you have a great attorney that you're working with. Make sure that you have good partners. When I was doing this before, Jerome, you did it by yourself. You did everything on your own. Now it seems people come together in partnerships. So you're going to have, like I'm doing a deal right now. I've got a couple of strong partners. And then we brought a KP in, a key principal, to sign on the loan, bring his balance sheet and his expertise. Between him and my expertise and my partners, the banks see certainty to execute a good, solid deal, which should bring confidence to the people who are investing as limited partners or passive investors in a situation where, on this particular deal, we'll raise a little over $1 million to close it and do all the capital improvements. So I think that you're not just banking on one individual today. But you are banking on a group of individuals, and people put partnerships together because there's more strength and certainty of execution in the partnership.
Yeah, but the thing that's terrifying about the partnership is the snake you like happen in your situation. So when folks are putting these partnerships together, what do you think are the things that they should be thinking about or looking for, or as the partnership is progressing and growing, what are the things that, if you could go back and talk to yourself 10 years ago, you would have changed or done differently?
I would have paid more attention. I would have listened to the people around me. My wife told me that she didn't trust my partner. And the funny thing is I never talked to my wife about business. But yet in 2008, I'm in a closing in Cincinnati trying to fund a deal. I can't get a deal funded from my office. I finally get my partner on the phone and he says to me, hey, I don't know how to tell you this. And I'm like, tell me what? He said, I had to move money from the escrow account. That's why I can't, fund this deal right now. And I said, you're not supposed to do that. He goes, I know, but I thought I'd have the money back. And so I get that deal dry closed, which means I just didn't fund it. I go home, I raise the rest of the money, give away some equity on the deal, and raise the rest of the money, get the deal funded later, the following week. Meantime, on Friday night, so that's Wednesday. On Friday night, I go to dinner with my partner and our wives. And on the way home from dinner, my wife says, I don't trust him. And I said, as a good husband, I go, hey, honey, don't worry, I got this. When really I should have said, hey, honey, tell me what you mean. What do you see? Listen, I think our wives, our spouses are smarter than we are, and we need to listen to them. God puts us together for a reason. And I believe today that if I'd have listened to her, I might not be in the position that I wound up in. And then the funny thing is, a week later, my attorney said to me, hey, I don't like what's going on. You need to look at this. And I said, Bob, don't worry, I got this, and I didn't. And because I didn't pay attention. And then it was a few months later that it happened again. And, I just, you
Well,
got to pay
so
attention to the details.
no, you're shaking your head, and it's a painful lesson. And I'm not trying to belabor the point, but I think there's so much learning here because the way that the industry has gone. People are meeting at conferences and saying they're going to build a partnership and do deals together, and they don't actually know the individual that they're getting in business with. So, did you know this guy for a long time? Did you meet him happenstance? Like, what gave you such confidence and faith and hope in him being a solid person and doing things the right way?
Here's the funny thing. We were friends for 25 years.
There we
Our,
go.
our mantra was that we would take a bullet for each other. This was even before we went into business. So, um, what I saw happen when looking back, what I saw happen was he couldn't handle the operations. The From where he came as a CEO, or I'm sorry, as a COO in an organization, he was really good at what he did. But now he was put in a position where he didn't really understand it as well as he should have understood it to be able to manage all of the business plans, manage the money, manage the people. Um, he wasn't good at the scale. I mean, we grew a company that had 138 employees, right? So he wasn't good at managing all of that growth. Neither was I, but he was more in a position and he handled all the money. So then there was some money missing. And then there was an affair that went on. So he kind of changed. And, you know, I'm not here to throw anybody under the bus.
No, and I
Fact of the
mean,
matter is, I still committed a crime, broke the law, disappointed my investors, and today I'm trying to regain my life.
us. Yeah, rebuild. So this isn't about throwing anybody under the bus. This is what you should look for, right? When you're in the partnership, what you should question or when you should be willing to challenge. And it doesn't matter the length of the relationship. If you see things that aren't appropriate, the willingness to challenge it and make
Right,
adjustments and draw boundaries so that you protect everybody,
right,
right? If you won't do it for yourself, do it for all the folks around you is kind of the place that I'm trying to get to because it terrifies me. As soon as you take somebody's money into the deal, you're now a fiduciary. You are now somebody who's issued a security. You are now, in financial services. It's a highly regulated industry for a reason. And, we are on the periphery of that doing the private equity or the private placements. And we just got to be super careful because the stakes are high.
yeah.
And most people won't talk about that.
You are held at a much higher standard. As soon as I take $5 from you, I am held at a higher standard, right? And I need to have a greater level of respect for that and for you. And Um, so, hey, listen, it was all about communication, right? I should have went back to my investors and said, look, this is what's going on. We hit a wall like a freight train. I said, our occupancies are down, our market has changed, and I tried to protect everybody from the truth. So one of the lessons I learned was, listen, I'm not going to protect anybody from the truth anymore. That they need to have the truth, no, regardless of how hard or difficult it is to deliver or hear.
That's that's meaningful. We think we're, and I know for a lot of operators, we personalize it, right? If the property doesn't perform well, it's our fault. So we're going to fix it, because talking to the other people involved in the deal would, one, admit that we weren't having success. And then I think two, would say that there's something wrong with the deal overall, and they may panic.
Yeah.
But being willing to just say, hey, we're in business, business doesn't always go as planned. Here's what happened. We want you to be a part of the solution. I think that's something that I think more of us can do, even if it's just a matter of saying, hey, there's something going on, but we got it covered. And so, Mike, I'm super appreciative of you jumping on and just being transparent and talking about something that's really uncomfortable. I just like to wrap up with some words of wisdom for the listeners. I think there were tons of jewels throughout this thing, but if you had to put a bow on it, what would you give the listeners?
Yeah, don't put, we all talk about putting blinders on, right, Jerome? And staying focused on what we're doing. And I believe in that, but also don't lose sight of your peripheral vision. Make sure you're watching what's going on around you and who's doing other things. Make sure that you're taking accountability of partners. Make sure you're reading reports, that you're getting the KPIs, the key performance indicators on balance sheets and profit and loss statements that are really giving you the detail that you need to have. Um, Make sure that you are, um, not over leveraging. Make sure you got capital. I think those are the key components that people need to be careful of. And
And
listen, you can go raise money and you can do a deal and you can syndicate a deal, and just make sure that your execution is spot on.
yeah, it's so hard when you're getting started, man. You guys vertically integrated so you could see the operations, but most people don't have enough doors to do that. And so they're third partying it, and you never know if that vendor's going to be amazing. And so much relies on or depends on the person that's on property, or your community manager, whatever you want to call it. You said something, and you brought it up two times. So I was going to wrap, but I really want to dive into this. You,
Okay.
you said don't be over leveraged, and you talked about being able to take 85% loans. I don't know anybody that'll make those loans anymore on multifamily. So, and you also talked about being 65 to 70% leverage. What does over leverage actually mean? And then how can somebody tell if they are? Like, let's go down that rabbit hole, because I think it's really valuable.
Well, when we were buying deals, so I did $60 million worth of real estate, and I was 15% in. So I was 85% loan to value on that portfolio. Um, the goal behind it, and banks were throwing money at us at the time, right? I mean, banks were just giving you money, just take it. I even had a couple deals in there that I was 10% in. So um, the fact is that there's a place, when you look at your metrics and you look at your due diligence, there's a place that the deal operates really well. And it generally is around 65 to 70% loan to value. And that's where you're going to see a strong cash on cash return, and you're going to see a strong IRR for your investors on the backside. When you change that leverage, it weakens that cash on cash, it weakens your operating income, things like that. So the focus was, okay, the market's going up. We don't think that, it's okay to only be this leverage, because in another 6 or 8 or 12 months, that gap's going to open anyhow. Well, it went the other way. And, one of the things people used to ask me, investors ask me all the time, hey, what's the worst thing that could happen?
You lose all
And
your money.
I said tongue in cheek, I said everybody could move out, never thinking that occupancies would drop like they did. But when the market, and being heavily invested in car markets and transportation, those were the markets that got hit the worst at that time, which caused a reverse in where we were and what we were doing, right? So it caused the occupancies to drop because people were out of business. They couldn't pay their rent, so they just moved out. They skipped.
That's happening right now, Mike. That's happening right now.
Yeah, I think that we're seeing some shades of 2006, 2007 right now, which people need to be even more conservative in their underwriting today. I have a partner right now that is very, very granular, very, and sometimes he just makes me mad. But you know what? I know he's so right. I know he's so right. But sometimes I'm like, man, stop this already. But he's right. So
Awesome. Awesome. Mike, this was an amazing episode. Thank you so much for jumping on and sharing your wisdom with the listeners. Guys, he's giving away a free book. Jump over and grab that from the website. And until the next time the Pack's with you, we'll talk soon.
You made it to this juncture, so you really love what we shared on this episode of Myers Methods Presents Multifamily Missteps. Do us a favor. Give us a 5-star rating. Give us a review. And share this with somebody who's interested in multifamily investing. Until the next time, the Pack is with you.